Good morning, Tony Sycamore here. It is Sunday, the 21st of March, bringing to you a video outline of the 5 key charts of interest for the week ahead. Let's start with the US bond market, which continues to push higher, as can be seen on this chart here. The interesting thing for me now is that US yields, after pushing up to that 1.75% high, have really broken out of this upward sloping trend channel. What this means to me, particularly the close above this trend channel, signifies that US yields are going higher and that we're going to be looking towards this 2% area in the coming weeks, coming months, potentially. The 2% level comes from this high over here. You can see this 1.98%, and as well as these lows over here, which provide resistance. So a big level here at 2%, but we're just 25 basis points away now, and I think that's where US yields will find themselves in the coming weeks. What that means for equities, well, we'll see. For the US stock markets, it hasn't particularly been a good thing, particularly for the high growth stock indices such as the NASDAQ. The S&P also has quite a good weighting of technology-based stocks. And when we were looking at this chart last week, we were talking about the possibility of the S&P pushing up towards this trend channel resistance. And following that test of the trend channel resistance, a pretty good little pullback developed into Thursday and Friday. This is part of the rotation we're seeing from high growth stocks into cyclical stocks, but it's also happening on a global level as well. US stock markets are actually getting hindered by the higher yields, and markets such as Japan and Germany are doing very, very well because they're net beneficiaries of the higher yields. So we're expecting to see this level continue to cap, but what generally we're expecting is more of this one step back, two step forward price action. And at the end of the day, we don't think there has been a change of trend in these stock markets, that this is just part of the process we're seeing, and that a test of 4,000 in coming weeks is still likely. Looking at what it means for the local stock market, the ASX 200, well, it's spent quite a good deal of time now between 66.50, this three lows we've seen, or 3 or 4 lows we've seen here in recent weeks, and the 68.60 to 68.70 area on the top side has been capping. Within the bigger picture, though, an upward sloping trend channel also exists, and providing this 66.50 support area holds, I would be looking for a push up towards 7,000. If at any time 66.50 breaks, and it's a sustained break of this support area, then I think we've got to start expecting to see a deeper retracement, initially back towards these lows here, coming in around 6,500. So about 150 points lower if 66.50 breaks on a sustained basis. Looking at the US dollar, it has been chopping around in a sideways range for the better part of a week and a half. Obviously, since the start of the year, there has been buyers and the trend has been towards the top side. I see this not as a change of trend, to be honest. I see this as a counter trend move. When we're looking at the big picture, the bigger trend is to the downside. So this is viewed as a counter trend rally. Now, when this counter trend rally still has a push up towards 9,300, we are going to find out. And I think if bond yields are going higher, that is probably the most likely course of action. So while the DXY holds 91.25, these lows which we saw last week and the week before, I think we need to allow for the US dollar to push a little bit higher up towards 9,300. Conversely, if this 91.25 level breaks, then be aware that the US dollar downtrend has probably resumed. But until then, allow for more price action into this area here. Finally, this week, I wanted to look at a commodity which is really catching my eye, silver. And why I like this chart is the fact that we have a 3-wave corrective pullback, which in Elliott wave theory is a correction. You can see that the primary trend has been higher. This 3-wave correction is initially of interest to me. Also of interest to me is the fact that it's held for the better part above this 100-day moving average in recent sessions. And what I'm looking for now is a break above these highs, 25.50 to 25.70-ish, to confirm that this corrective sequence is over and the uptrend has resumed. So really liking what I'm seeing here at the moment. Bullish, but becoming more bullish on a break of 26.70. Thank you for listening. That's all for this week. If you like our videos, please subscribe to our channel. Thank you.